Elon Musk recently addressed growing concerns around silver supply, and what stood out wasn't a headline or a viral quote, it was the implication behind it. When someone operating at the scale of Tesla and SpaceX talks about material constraints, they are not speculating, they are describing operational pressure. And right now, that pressure is building around silver. This is not about whether silver goes up or down next week. This is about a structural resource constraint colliding with exponential industrial demand in a system that has no fallback plan. If you're getting value from this analysis, hit the like button and subscribe so you don't miss what's coming next. Let's be very clear about what this actually means. Silver is not optional anymore. It is a critical industrial input for the energy transition, defense electronics, advanced manufacturing, and next-generation infrastructure. Every solar panel requires silver paste for conductivity. Every electric vehicle uses significantly more silver than internal combustion vehicles. Charging infrastructure, battery management systems, grid electronics, all of it depends on silver. This demand is not speculative. It is engineered into the technology itself. And here's the problem. The supply side is not responding. Global silver mine supply peaked years ago and has remained structurally constrained ever since. This is not a temporary disruption. This is geology. The easily accessible silver has already been mined. What remains requires deeper drilling, lower ore grades, higher energy input, and more capital. Meanwhile, demand is accelerating at a pace that has no historical precedent. We are not talking about incremental growth in jewelry or photography. We are talking about mandatory industrial consumption required to execute the largest infrastructure transformation in human history. Solar installations alone are projected to consume a massive share of annual silver output in the coming years. Add electric vehicles, 5G infrastructure, data centers, and military applications, and the imbalance becomes unavoidable. When inelastic demand meets constrained supply, price must adjust. But here's where the system breaks. Silver prices have not adjusted properly. For decades, silver has been priced primarily through paper markets. Futures contracts, derivatives, and leveraged instruments dominate price discovery. On some days, more paper silver is traded than the amount of silver mined globally in an entire year. Physical silver and paper silver now exist in two different universes. The paper price is driven by financial institutions, trading contracts they never intend to settle physically. The physical price is driven by industrial users competing for limited refined metal. That gap is no longer theoretical. It is widening. Industrial users cannot afford supply disruptions. If manufacturers cannot source silver, production lines stop. Solar output stalls. EV manufacturing slows. These companies do not wait for futures markets to normalize. They secure supply directly, even if that means paying premiums far above the quoted paper price. And once long-term physical supply contracts start getting written at scarcity-based prices, the paper pricing mechanism becomes irrelevant. Because the paper market only works as long as participants believe contracts can be settled physically if needed. The moment that belief breaks, the system collapses under its own leverage. Now add another layer to this problem. Governments and central banks have spent years discouraging physical asset ownership. Physical metals are taxed, regulated, and made difficult to move across borders. Why? Because physical assets exist outside the financial system. Stocks, bonds, currencies, they are all claims on institutions. Physical silver is not a claim. It is the asset itself. And in an environment where currency debasement is no longer a policy choice, but a mathematical necessity, physical assets become the only store of value that cannot be diluted. This is why physical silver premiums are rising even when paper prices appear subdued. Refineries are reporting delays. Delivery times are stretching. Industrial buyers are quietly paying up to secure supply. And retail buyers are discovering that the price on the screen does not match the price required to actually obtain metal. This is not coincidence. It is a system under strain. Banks and financial institutions still hold large, short positions in silver through futures markets. These positions profit when prices stay suppressed and face catastrophic losses if price discovery shifts to the physical market. That creates an incentive to continue selling paper contracts to control price momentum. But paper contracts cannot create silver, and that is the trap. The moment physical demand overwhelms available supply, price discovery moves away from trading desks and into refineries, warehouses, and industrial procurement departments. At that point, silver is priced by necessity, not by financial engineering. There's also a monetary dimension to this that cannot be ignored. The global monetary system is under stress, debt levels continue to rise, central banks are constrained. They cannot meaningfully tighten without breaking the system, and they cannot ease without weakening currency credibility. In that environment, hard assets regain monetary relevance. Gold has already moved, silver historically follows, but with far more volatility due to its smaller market size and dual industrial role. Unlike gold, silver is consumed. It disappears into products that are never fully recycled. That creates a permanent draw on above ground inventories year after year. Once sovereign entities, industrial users, and long term capital begin competing for the same finite pool of physical metal, there is no stabilizing mechanism. There is no lender of last resort for commodities. There is no central bank that can print silver. The only adjustment mechanism left is price. This is why warnings coming from industrial operators matter more than analyst forecasts. Companies operating at scale do not publicly acknowledge supply constraints unless those constraints are already affecting planning and procurement decisions. That means the lag between physical reality and paper pricing is narrowing rapidly. This is not about predicting a specific price target. Structural imbalances of this magnitude do not resolve gradually. They resolve through repricing events that occur faster than most participants expect and with more force than risk models allow. And when that happens, the distinction between paper exposure and physical ownership becomes painfully clear. One is a derivative dependent on trust in institutions. The other is the asset itself. When Elon Musk signals concern about silver supply, he is not commenting on markets. He is pointing to a system running out of margin for error. And by the time mainstream narratives fully catch up to the physical reality, the repricing will already be well underway. Because supply crises always look invisible until the moment they become impossible to ignore.
Hello, my dear friends. Welcome back to my new video and my channel. So, friend, today Elon Musk recently addressed growing concurrence around silver supply, and what stood out wasn't a headline or a viral quote. It was the implication behind it when someone operating at the scale of Tesla and SpaceX talks about material constraints. They are not speculating, they are discovering operational pressure, and right now that pressure is building around silver. This is not about whether Musk recently addressed growing concurrence around silver supply, and what stood out wasn't a headline or a viral quote. It was the implication behind it when someone operating at the scale of Tesla and SpaceX talks about material constraints. They are not speculating, they are discovering operational pressure, and right now that pressure is building around silver. This is not about whether